All right, thanks, John. Hey, guys, welcome, everybody. Thanks for joining us. I work with both Manesh and John, and I think we've put together... Hi, John Turpin from Atlanta. I saw you on there a while ago. This is actually John Bullock. I'm logged in as John Person Jr. That's the way I had to log into Omnovia tonight, but it's actually John Bullock. And if anyone's in Atlanta, John Turpin runs a great meetup group, so I'll shoot my email address out, and I can get you in connection with him if anyone's in Atlanta to be a part of his group. But so we have a great webinar for you guys tonight. We're going to talk about high probability breakout trades. Both John and Manesh have different indicators that look for these type of trade setups, and they're going to spend about 50 minutes each in a presentation teaching you guys some different ways to identify those breakouts. And then a lot of people asked if we are going to record it, and we are going to record the video, and we'll get that sent out to you. But tonight should be a great webinar. I hope everyone learns a lot. If you have questions, we'll try to answer them as we go. We've got quite a few people in the room here, so we'll try to answer them as we go. But I'll go ahead and let John get started. So thanks, John, and I'll let you fire away here.
Very nice. Welcome, everybody. And I just think that we've had a lot of good, it's been kind of an interesting market, and I think we've had a lot of great setups. And you know, I just did a presentation which is kind of ironic, because I just gave a presentation in Atlanta over the weekend, and a couple of the patterns, and especially we're going to go over them tonight, and the scans that we look for. In fact, today, in our own trading room, I'm not sure how many, Ruth, you were there. We talked about McDonald's as a high close doji. Sonia, I know you were in there. I'm not sure if Diana or Gary was in there. Gina, I know you were there. Today was kind of an interesting day trade day. It's just all been about more of the volatility in stocks rather than volatility in the overall market. But there's some great things that we've done and we look for and we scan for, and we're going to go over that tonight that I think is going to help a lot of people. So it is being recorded, number one. Number two, if you are having a sound issue, because we've done all the sound checks and they're all good, do me a favor. You might have too many browsers open. If you have too many platforms which take broadband width from your internet, it will cause intermittent latency problems with your sound. So close out excessive browsers, A. B, close out other programs that you have. I think Omnovia, I guess unofficially I could call it a memory hog. I'm not sure how that all works, but anyway, that's how you can get that going. So first and foremost, the irony about in tonight's presentation is that this presentation was when I had a little darker hair, is kind of old, and why I think it's ironic is because it's got this, like, one of my favorite patterns, the compression pattern, but also it's hard to see. There's a dot, a buy signal setup, and a momentum indicator, which is what this is about tonight. And you know, Manesh has a very unique methodology that he teaches, which is a method that I think you will find useful, in the sense that it's something that goes hand in hand with what I'm going to be sharing with you tonight. First and foremost, let's get right going. We do have a disclaimer, so let's make sure that everyone takes a moment to understand that trading is risky, and that past performance is not indicative of future results. And this presentation is copywritten material by me, John L. Person, so it is for your benefit and education only, not to be reproduced and redistributed. All right. So for those that do not know me, and I think that there are a lot of people in the audience that are relatively new to our room for the first time here, and maybe perhaps Manesh, I just want to let you, if maybe you've seen some of my work in the past and weren't familiar with it, this book here, I'm proud to say, Candlestick and Pivot Point Trading Triggers, is now a decade old. That really launched the popularity of both pivots and a few candle patterns that I'm going to share with you tonight, which are a part of my repertoire for looking for strong momentum and high probability setups. The book below it, Mastering the Stock Market, that book came out, now I can't believe it's 3 years this thing came out. 3 years ago, we talked about how people were struggling. There's an indicator that I use instead of volume histogram. I use OBV, on balance volume. It helps to define the trend of volume. I think a lot of people have been struggling in recent years with volume analysis. Market moves up on light volume using volume histogram bars, and it's been causing a lot of individual traders a lot of confusion, because most people are taught that, you know, a good, strong, healthy trend is on rising volume. But you must take note, there's a reason, and I explained it in that book now 3 years ago, 2.5, 3 years ago, that book came out, Mastering the Stock Market, which explains the viability and the edge that using a volume trend tool will give you in this day and age, because due to the advent and the increase in popularity of dark pools, number one, and options trading. Options trading, a derivative market, people can do a synthetic long position in an options market instead of trading the underlying. Like today, for example, instead of looking at McDonald's, instead of taking McDonald's on and using the capital of at the time a $94 stock, you can do a stock replacements type strategy. Short term, you're looking for what? Maybe a high delta in the 70-80 range. A longer term, 90 days, you might drop that down to maybe a 35-40 delta. So with that said, just remember, if you do have options traders increasing their activity instead of trading the underlying market, the volume, the option volume, is not going to be translated to the histogram volume of the instrument you're trading, and that's the relevancy. I have the logic behind what I've been teaching people for years. It was covered in that book. Of course, my contribution with the Commodity Traders Almanac was a lot of people really enjoyed that, and looking at not just commodities, because a lot of people say, I don't trade soybeans. I'm not interested in some of that stuff in cattle and meats. But what we did is we created the idea and linked how high correlated stocks are linked to the seasonality of the underlying commodity, and that's what we brought to the table. They did discontinue the Commodity Traders Almanac. The last issue was the 2013 issue. It was one of the best books. I think it was just a great book, one that is still will work, because what we put into that book was all types of ETFs and high correlated stocks to the commodity markets. Anyway, some of you might be familiar with my indicator on Thinkorswim, the PPS, and of course Person's Pivots. Now we have a couple things we're going to teach tonight, and how to utilize two patterns that were written 10 years ago that are effective 10 years ago. They're more, if not as effective today, and that's the high and low close doji scans. So what I look for, and it really does not exist, so this is kind of a teaser title, is the perfect trading method. I mean, the ability to spot a high probability, meaning it's not going to be perfect, it's not 100%, but it's better than, say, or just under 70%, meaning 7 out of 10 times, if you have a pattern that you see materializes 7 out of 10 trades, if it works, then it's a high probability. What we don't know is what will be the profitability on the outcome. What we do know is, will the pattern, the setup, once it gives a trigger, which is a call to action to get long or short or in or out, once that trigger is mechanized, then do you have an ability of understanding where to place a stop loss? So one thing is identifying a setup, knowing what the trigger is, and then having a defined risk. And then again, when you have that high probability setup, having an idea of a specific entry level, not just based on price, but also time. And time is important, and I'm not talking about time of day. I'm talking about time condition. Is it on the open of the market or the close of the market? That's very important, because if you're looking at a daily chart, obviously if the market's near the close, you can either buy on the close or buy on the next session's open. If it's a Friday, for example, and you're trading off a weekly chart, it's real simple. If you have a trigger that says buy on the close or the next session's open, you can kind of control your entry by looking at the very next session's open. So daily, weekly conditions, that's what I mean by time condition, is open close. Not at 4:33 and 17 seconds get in. I'm talking about based on the open and the close. And then again, what's really important is bullet point number 3, knowing the expected time frame that you see expected results. Meaning, if I have a pattern, think how helpful would this be to say, if I got a pattern, I should see results within 2 time periods. So if I have a 5-minute chart, I should see on a 5-minute chart within 2 bars, which is 10 minutes. If I have a daily chart, I should see expected at least some type of results that if I'm in a bullish pattern, I should see what? Expected bullish outcome, meaning higher highs, higher lows, or a profitable trade within 2 bars, right? 2 bars on a daily chart is 2 days. If it's a weekly time frame, then I should see expected results or at least positive performance within 2 weeks, so forth and so forth. And that's what I mean by the time frame to see expected results. So setting initial profit targets for scale outs is important, and of course understanding price levels to trail stops. If we can nail down those 5 bullet points, there's one missing that's also important, number 6. Number 6 isn't about the breakouts, it's more about trade management and position sizing. You know, there's an old adage, whenever you're right, you're always in 1. Whenever you're wrong, you're always in 100. That's an old floor traders adage that we used to joke around about. But, you know, it's true. Most people, they get that gut feeling and they get into more positions than they should. And then when the trade doesn't work, they're, of course, you know, behind the 8 ball, so to speak. So position sizing is having the ability to be disciplined and having a stagnant amount of orders per your equity is very important. Money management technique, very critical to this business. So let's get right to the point. Many of you, if you've seen me before, listen, this is kind of a very intriguing situation because we are seeing this pattern perform immensely across a spectrum of various markets still, and especially in the U.S. equity markets. Now, we've had a tremendous run so far. You know, if we turn the clocks back at the end of January, the 1st of February, there wasn't a soul in this world who was, well, maybe there's a few people like ourselves that were bullish the market, but everyone was bearish this market. And this, you know, I'm referring to the U.S. equity markets. Most analysts, the media, the news, everywhere you turned, it was getting ready to crash. And the funny thing is that we saw this pattern that I disclosed and wrote about, published over a decade ago, called the bullish high close doji setup. And I dub that the HCD. So if you've ever seen my tweets or if you've seen anything that I've put out and I say, hey guys, we got a bullish HCD on the horizon, or we have a bullish HCD pattern, there's specific rules. And the rules are, after a downtrend, when a doji forms, it's kind of in the family and the kind of concept of a morning doji star formation, which is a 3-candle formation. And it's very bullish. The problem is, I never really saw that pattern materialize. Being a trader, I want the most aggressive bullish patterns. If I'm bullish, I'm looking and scanning for those. But what most people don't realize is clearly you can see what a doji is. It's where the market just about closes right about where it opens. So for new traders who are not familiar with what doji is, it's a candlestick that after forming a range, a high and a low, market opens, it goes up, it goes down, or it opens, it goes down, it goes up, and it comes back and closes right at almost exactly where it began. What the trigger is, the setup is after a downtrend, keyword, after a downtrend or after a pause in the market, we see a doji formation. Within a few bars, there's specific rules there, but let's just keep our eye on the prize here and keep focused on this. We want to see them within the next few bars, we want to see the market close above the high of that candlestick. So if you notice, that's what the dashed line represents. The dashed line represents the level of the high of that candle. When we get that, that's the call to action. That's the actual trigger. You're buying on the close, or the next sessions, it's synonymous, next sessions open. Now, we have the trigger. We have the setup, which is the pattern, the doji, after a downtrend. The trigger is when the market closes above the open. So what is the risk? The risk is your stop loss goes underneath the lowest low or the doji of the past prior 4 bars. Those are my rules, okay? Now, the opposite is true for the bearish low close doji. But I want to focus on the high close doji. A couple things happened, and I want to go back. And this is kind of recent history, and we got some really neat stuff to share with you tonight. I think this is going to be really instrumental because it's not just about price, the high and low close doji are probably the most powerful and most frequent and high probable patterns that I've seen come across my desk in 35 years of trading. That's why my story doesn't really change. My teaching doesn't change. I haven't switched to methodology. There's really nothing new to teach people because it's still working to this day. I have certain things that I like to share with people that help give us an edge on the condition in which we look for the high or the low close doji, which would be maybe some volume, some seasonal analysis, and I'm going to share that with you right now. Okay? So basically what we're doing is we're going to go back, and if you remember back on February 2nd, one of the things that we talked about was for people to buy some Fed Spider 207 calls and the IWM 120 calls, because we were bullish in the market down there. At the time, they had 30 deltas. Many of you might argue with, hey, why is he buying a 30 delta? Well, if I'm expecting a very bullish move and an immediate price increase, a 30 delta on an increase in an underlying market of, say, 3 to 5%, a 30 delta is going to change pretty quickly. So there is a time, a rhyme, and a reason to buy out of the money options within specific patterns. And the high closed doji and the low closed doji are two of those instances. If I'm expecting immediate results, then I don't have a long time to wait. I know that if I'm going to be right, I should be right almost immediately, not I have to wait around and watch theta decay. And I certainly, if I'm looking for an immediate move, an immediate breakout, okay, one of the next things that I don't have to worry about is putting on a vertical call spread, because I'm not going to be sitting there waiting till expiration till the results come around. I want to see immediate results within 2 candle bars. All right? That's the key. So that's why we actually have created daily and intraday scans for this stuff. One of the things that we did is we noted here, and I want to share this with you, on or about from January 30th through February 3rd, we picked up scans for high closed dojis in a multitude of diverse sectors and different stocks. Funny thing is, we had Charles Schwab, Regions Financial, in a regional bank, SMH, which is an exchange traded fund on the semiconductors. So it wasn't just on an individual stock, it was on an ETF or a sector itself formed a high closed doji. Cognizant, Red Hat, Akamai Technologies, Industrials, GE, Best Buy, Ford, Owings, Illinois in the materials sector. Two that were very popular that I focused my attention on that I want to share with you tonight was not as the world, and you go back and think down memory lane, and I'll share with you about this too. But there was, remember in crude oil, everyone was, by the time January came rolling around, everyone thought that crude oil was going to go to 20, 30, it was going to keep going lower. Well, the funny thing is that in the middle of January, we actually put this on our blog site. We posted this. We taught about it. We screamed from the highest mountain here in Florida. That's an inside joke. There are no mountains here. But maybe the parking lot at least. We had the OIH and the XOP, two energy sectors, generating high closed dojis, the sector itself. ConocoPhillips, COP, a position that we took long. RDC, in the media, XTC. These are, what's highlighted in green, by the way, are not just stocks, they're ETFs. Now here's another one which was very interesting, was in the home builder sector. Now some of you, I'm not sure if you're trade station users, but every Thursday I do this. I know we were promoting, looking at ITB and all the housing sector stocks like Toll Brothers, Lennar, Pulte, even KBH, KB Homes. I think DH Horton's another one. Home builders, the actual ETF on home builders, the ITB generated a high closed doji. That's very powerful. Retail apparel, like for example, limited brands, which is Victoria's Secrets, TJ Maxx back then, and Ann Taylor. In fact, A&F, I put out a free tweet, and the next day it had a daily high closed doji. Hey guys, look for an immediate reaction. The next morning it opened up a little lower, and at the end of the day it was up 5%, a nice 5% move. So, I mean, these are kind of some really neat stuff that I think that's happening in the market right now. It's happening even today, and I'll share with you what even tomorrow looks like, because we've already done our homework for tomorrow. So this is very easy to learn. We've had a huge success using it, and I think that this event tonight promises to give you some very powerful insights that I know that you're going to be able to apply immediately, and I'm going to walk you through this entire session and go over the details. So I'll be providing you some information as well on how you can receive some follow-up training if you're interested directly from the originator and the true master, which is me. So I know that you're going to have a great event tonight. So this is Ann Taylor. This is, this is Abercrombie and Fitch, ANF. This was the stock that we put out that buy recommendation just to show the results. This is on a 60-minute chart. What you're looking here is a candlestick chart. It's a 60-minute chart intraday. When you see an orange candle, what that signifies, if you notice 3 bars to the left, there's a doji. Note the high of the doji. The market closed above that high of the doji, triggering the call to action. Now, we want to see within 2 bars. Within 2 bars, we want to see some positive action. What's positive? Well, we made higher highs, and we still contained between the low there. We made higher highs. We started to see a little bit of nervousness, but by the 3rd bar, right on cue, it had follow-through. What you're looking in the middle is a histogram. It's a momentum histogram. It tells us, it gives us advanced warning whether or not the market is coming into an overbought territory, number 1. Number 2, it tells us if we're getting convergence. So as you see, price is making newer lows. Note that the indicator is making higher lows. And all of a sudden, you'll see that the indicator has turned green. But that's not the real issue or confirming indicator. It's this thing down here. It's called on balance volume, and everyone has access to using this tool. If you've been struggling with volume as an indicator using volume histogram, may I introduce you to how to use on balance volume to help determine trend of volume. As you can note here, we are seeing, as the market's starting to move up, we're starting to see the volume come into the market trending higher. So that tells us that there is positive momentum. The breakout, the trigger, the call to action is the high close doji. Now, what's interesting about that is that the retail apparel sector formed a daily. Now, this is pretty wicked. Don't get me wrong. This has a great pattern. It's a high probability, but the neat thing about it is instead of using it to trade, because in this situation, the risk, if you buy on the close or the next session's open, your risk is below the low of the doji or the lowest low of the last 4 bars, which is the doji in this case. So with that said, the sector itself had bottomed out. The sector itself had bottomed out and was generating a positive momentum. Now this is the weekly chart. This was a daily chart. This is a weekly chart. So if you note, the weekly is positive, the daily is positive, and now we're in multiple time frames that are giving us true trend direction. So what I like to look at, and I wanted to point out to you, this is Ann Taylor here, strong volume. If you take a look at the OBV, as price isn't moving higher, if you take a look at this, you will see this blue line is making higher highs and higher lows before the trend of prices broke out. The market actually was making a higher high, showing accumulation in this stock before price broke out. The real trigger came right here. If you notice what the date is, this is not 1936. This is just 4 weeks ago, 3 weeks ago actually, a high closed doji. So we had a seasonally strong sector, we had the same sector, we had volume indicator, we had like or kind stocks all joining in, forming literally at almost the same day, the same type of pattern. This is limited brands. Literally, folks, different company, same pattern, limited brands, the same story. High closed doji. Now, this is a stock that I think is very interesting because here we have something that's totally off the rack, not even close to the same sector. But one of the things that we see is as we are looking for the stock market on, if you remember, back in late January, exactly Friday, January 30th, the stock market closed lower, and on Monday, on February 2nd, when it opened up, it was a little scary, but we were at the bottom of a trading range in the S&Ps, and numerous stocks were not conforming to the overall sector's weakness. A lot of stocks were actually generating, and this is TradeStation, and what we've done is color-coded the high-closed doji. Blue is doji, orange is a high-closed doji. This stock is on the breakout of a momentum move, and again, what is the common denominator with just a few charts I've shown you? The common denominator is that it seems to be moving with a rise in the on-balance volume indicator. Just remember that. Very important point. But what's also a common denominator, this is the weekly chart. All right? This is the weekly chart which reflects the market was already in a weekly buy mode. So when you take a look at the fact that the market was in a buy mode at the end of February the 23rd, 3 days later, or basically the next few days, we had the market generate a daily high closed doji while the weekly was in buy mode. So the key element is the volume starts to rise. We see a very positive momentum, high probability pattern ensue. By the way, this is a screenshot today. This is my TradeStation page. And what I wanted to share with you, today in our trading room, at exactly, I think it was 10:38 this morning, Eastern Standard Time, I put out and started going all through our high closed doji list and said, gee, McDonald's, it's in that. I had no idea that McDonald's would move that much today. But we did announce we had a daily high closed doji and that the stock was due for a major pop. Remember what I did tell you about the common denominator between all the last few examples? Look at the on-balance volume. The volume is on the rise. Notice the weekly. See that little dot? Many of you that are familiar with our indicator, which is very popular on Thinkorswim, it's called the PPS. It's a momentum indicator. It gives definitive buy and sell signals. In fact, they show up as arrows. As you can see here, that little blue arrow showed McDonald's actually 4 weeks ago, the same time frame, the end of January, generated a buy signal. So while the world thought the stock market was going to crash, McDonald's starts generating silently a little buy signal. And note the volume, the coincidence of the volume. The funny thing is, note here, I've just done this for your benefit. This is the volume histogram below, and this is the on-balance volume indicator. Volume below, I don't know what that's telling people, but I'll tell you what it might do is scare people out of trades. Versus, look at the definitive trend in the volume with the on-balance volume. You can see that clearly it's on a higher rising trend. It does have a moving average component, which I've overlaid, which helps to define the fact if the average daily volume is on the increase or on the decrease. Volume histogram, and we had one of the gentlemen in the session tonight said he loves synthetics. Now keep this in mind. If I did a few of these, like say longer term options, call options, directional, because I'm looking for results in the next day or two and I want to maybe ride this trend up, perhaps maybe thinking it's going to get to 100, 105 by maybe June. Okay? If let's give that supposition just out of curiosity. If I put on, instead of buying a stock at 95 bucks, right? If I went with a synthetic or just a directional long position, is that volume that I bought call options going to reflect in the underlying volume of this stock? And the answer is absolutely not. And so therefore, my theory that I've been explaining to people for years now is that it's not going to be reflected in the volume levels. And so you can clearly see the divergence between the weekly volume, which is the middle chart right here. You can see the histograms on average are moving lower, where you can see the yellow line, which is the on-balance volume, moving higher. This gives confirmation that there's more accumulation of positive buying, not negative selling. So this is on an intraday basis. This was exactly 10:38 this morning when we were talking about it on an intraday basis. And the funny thing is, look at the coincident factor here. Even though my momentum indicator is positive, let's talk about that later. I want you to take a look at the direction of the on-balance volume. It's pointing up. Now, on an intraday basis, I'm not sure what the volume's pointing to here, but it's not until about 1 o'clock that you finally get an uptick in the volume. So for once, we've got a kind of a matchup between the volume coming into McDonald's, and it really started to pick up as the market started to break out at approximately, as you can see here, this right at 2 o'clock, the 2 o'clock bar. That's when we saw a high volume bar. But the volume and the trigger literally came on the yesterday's close. It was a high close doji, and this is probably the pattern that I like to see is an accumulation type of coincident factor between not just the price moving up, but also with the on-balance volume in concert. Not only that, but there's a third element. The weekly is already in a buy mode. So if the higher degree time frame's in a buy mode and you get a pullback on a short-term basis, and so this was the short-term basis pullback. Everyone can see that, right? Weekly went up, it pulled back to the weekly moving average, and something happened here to get an explosion to the upside. What was the pattern? It was the high close doji. That was the intraday picture taking a snapshot, dissecting this market. So obviously there is a something out there with the high and the low close doji still in effect and ways to improve on it, and that's what I am sharing with you tonight. There are things that we do to try to improve on that. Now, we have the high close, low close doji scan, and there's a couple things that we again want to look for going into tomorrow, by the way. All right, and let me go back. I'm going to change this. So this is just to share with you. Let's go with Mickey D here real quick so you can kind of see this. I'm going to expand this up and let me go to format analysis techniques. Let me turn this volume back on. Okay, so here's what I'm kind of sharing with everybody here real quick. While this, you can kind of see this volume. I mean, the trend is really not doing anything. What do you think? Is that an accurate depiction? The average, take out 1, 2, those 3 bars. But that's the average trend of the volume. Would you agree with that? The trend is sloping downward. It's certainly not sloping upward, right? Would everyone agree with that? And there's a clear divergence between that yellow line. This thing is forming, as you can see, and it might be easier if I do something else here real quick. I hope I don't disrupt the quality. Everything's running smoothly. There's no technical difficulties here. I'm just going to use this other feature here. Just give this a second. It's a great little drawing tool, and it's going to allow me to do some things to point things out to you that I think are instrumental. Number one, you can start to see this yellow line forming almost the bullish pattern within itself. Is this not forming higher highs and higher lows, right? And it's trending up. This is just, I don't know what this is doing. It's there. It's not giving you an edge in the market. All of a sudden, we get a high close doji. And one of the things that I talked about in the trading room today, I should have just grabbed everybody by the throat and said, McDonald's, get in it this second. but I posted it in the room, McDonald's, and I went on a little bit of tangent about, it could be the surprise, the attack, yada, yada, yada. But boy, I'll tell you what, if you're looking for a move with one, this was a very strong surprise to the upside. We are seeing these kind of moves, but the coincident factor once again, I think is the series of other factors that are related to this analysis, and that's in the sense that, number one, we have had a buy signal, and that buy signal, just so that you can see, review data window here, so let me get this so that you can see, was generated on the week ending February 6th, okay? Now, when I talk about the stock market, and I probably should have just started off with this immediately, okay, is that everyone, and when we go back down memory lane, and you go back memory lane, it's tough to remember things after 3 days. I don't even remember what I had for dinner 2 nights ago. But back on, as you can clearly see, this was a situation where, and it has been in the last couple days kind of an interesting trade. But boy, on February 2nd, that was February 2nd, that Monday, that was January 30th. On January 30th, I mean, there was narrowly a soul that would say this is in this market. A lot of people thought this thing was going to crash and burn. It looked a little ugly there. We had a lot of the volatility, and a lot of people were looking for follow through, and they were looking for the market to move down. The kind of funny thing is that when the market did move down on January 30th, we didn't have a breakdown in my advanced decline, and we did not have a new breakdown in the volume. We were in a trading range. And my famous last words, and we have some experienced witnesses here just to make sure I didn't get forgetful. I said, folks, we're in a trading range, and in a trading range, you do not sell. You look for buy signals, and you look for buy setups. So we have some definitive trading tools. The volume analysis is one. And just to be, just out of curiosity, we'll take a look at adding. Let me go over here to insert analysis technique real quick. I'm probably overstepping the boundaries of getting into too much right now, but I wanted to share with you as far as changing settings and stuff like that. That's a very risky, that's a very low probability trade in a live presentations, is starting to change settings on the computer. Murphy's Law kind of comes into play sometimes, and we break things. That's hopefully understand my sense of humor. I probably should just stay on subject and not change, but what I wanted to share with you is, we have a volume, the histogram here on the S&P 500, that quite frankly, when the trend of the market is up, the volume is down, and you can see it from this low to this high, right? And the on-balance volume moves up. As the market moves down, the volume goes up, but on-balance volume doesn't move down that much. You see what I'm referring to? There was greater volume in the histogram reflecting more selling pressure, which is a false. It was a false and not an accurate depiction. There are two distinct differences when you examine this, and that's what I wanted to share with you. Two distinct differences between the volume histogram and the on-balance volume. And so with that said, I think that's what's kind of been tricking a lot of traders. So when I come in tonight and I say, hey guys, I really think it's important and imperative that if you even said, oh, I've seen his stuff, I bought his book, well, go whip out that book again. I think it's page 214 or 216 on Candlestick's Pivot Point Trading Triggers on the High Close Doji and the rules, and go review those bullet points, because they're, if not as effective as I wrote about them over a decade ago, as they are even right now today. So they're very consistent, accurate, and highly effective. This is my 35th anniversary year of active trading. I first started back working for George Lane, who as many of you know, created the indicator known as stochastics. I started working with Uncle George in 1980. Now, one of the things that I've noticed, even back in those days, that we used to look for
Hey, John, we lost you on the audio. If you can hear me. Thanks, Terry. Hey, John, if you can hear me, we lost you on audio.
All right, how about now? Are we doing better? Testing.
Yeah, we got you now. Thanks. We got you.
All right, well, I gave too much credit. It was my fault for going on to a live chart. But anyway, what I wanted to say is back in the 80s, I used to look for changes. The point being is I think the picture will speak about words. Folks, this is crude oil, okay? By the way, crude oil generated a high close doji. Again, a different market. It's got nothing to do with limited brands. Crude oil really doesn't have a whole lot to do with McDonald today. Notice the sequence of events. Rise in OBV, nice high close doji trigger. This was crude oil. While the world was thinking that crude oil was going down, the funny thing is, and how does that relate to this page? Because I think it's very important that we look at some of the cash markets and we look at some of the stocks in the cash market. Back in the day, I used to look at the Dow Jones Utility Index. Back in the day means back in like 1984. We used to look for changes in the Dow Jones Utility Index for a directional edge in bond prices, by the way. So utility stocks would actually lead the way. They were a leading indicator for bond prices. So, and it's still, by the way, that's an old technique. It still works to this day. And if we normally had a week to 10-day lead time. And that's why I included that information in that Commodity Traders Almanac book. So, in any event, looking at crude oil, one of the things that you'll notice here, this is the XOP, and I was pretty hell-bent on buying the XOP. We actually put this in. If you go to our website, personsplanet.com, many of you are familiar with the website, but later today or tomorrow, whenever you get a chance, if you want, there's a blog. You click on this blog, and what we did is we put out a lot of really neat information. We've done it for weeks. In fact, I think it's probably under January for the week beginning the 26th even, it was so important. Look at this. OIH generated a weekly HCD bullish pattern. This comes out every Monday morning, all right? XOP closed positive 2 on the week. Q's generated a weekly HCD pattern. So, I mean, this was pretty accurate, timely information. You can go back and read that stuff on your own time. It's not password protected, and we put that information out just as you see it here. So with that said, I want to go through some of the stocks because while the world, this is the joke on humanity, I think, if we can teach and learn how to be our own analyst, and I can teach you what to look for, I think you're going to become better traders and have better faith in yourself and show more consistency. While the world was bearish on crude oil, people weren't paying attention to names like Phillips 66, which bounced right off monthly pivot support, a rise on volume. We had a PPS buy signal, and it wasn't until the 28th that crude oil bottomed. So the stocks were already on the rise. This is Valero Energy, same thing. Buy signal ensues, rise in volume, and it wasn't until approximately a week later that crude oil bottoms out. The Sorrel, the same thing. It bottoms out literally a week and a half before crude oil bottoms out. So the stocks actually led crude up first. This is just Baker Hughes, another example of how the entire sector
bottomed out in the middle of January, literally between a week to 10 days before crude oil prices. So the buy signal, the PPS buy signal showed up on scans, the high close doji. This is kind of a quasi doji right there. It's quasi because it's not an official doji. It didn't close exactly at the open, but I have a specific rule for a doji creation. If the close is within a certain percentage of the overall range relative to the open, we call it a doji. Because sometimes, within a penny or two or 3 cents or 4 cents on a stock, I mean, that's just, a settlement. It's pretty darn close to what the doji represents. This is Schlumberger. Now, there's no price missing. It gapped lower. This is a gap in prices. But needless to say, remember I started off by saying if I'm going to get bullish on a stock, I want to see like or similar patterns on stocks in the group, because institutions don't tend to buy one stock. They tend to migrate towards the whole sector. And so on one day you'll find many stocks going up, and on another day you'll see more follow through as they add to the position and buy like and kind stocks within that sector. All right? And I know you've seen that before. You don't just see one or two names go up. You see the entire sector get up, lit like a little Christmas tree. Any event, ConocoPhillips, this was the trade that we decided to take. It had great, outstanding volume. We had a profit objective in mind. We thought this market would minimum objective get up to that 67.5 area. We had a gap in the market. We had persons pivot resistance. But it was a great little trade that we take just to demonstrate, okay, some of these other names have taken off, but we have another volume and another PPS buy signal. We have another bottoming action in the market. This is an excellent looking trade, and it turned out to be nice for all of us. Similar situation, different event. This was Starbucks, which was another one we tweeted out. Starbucks, right before earnings, had this nice wedge formation. One of my favorite little patterns that I like to look at. In fact, McDonald's if you look at McDonald's monthly chart, I'll go back. I'm not saying it's going to be a wedge formation, because if it is, boy, I'll tell you what, that's going to be something special. Let's take a look together real quick. I mean, can you imagine? Is this just a trading range, or is this an eventual longer-term wedge? I don't know. Maybe in my lifetime, McDonald's could run up to 140. I mean, who's to say it can't, right? Chipotle Mexican Grill charges $8 or more now for a burrito. They put beans and rice in it. Why can't McDonald's? I don't know, capitalization, whatever. But I'll tell you what, we actually went, at the very least, just to study this chart together. One of the things that we've talked about on today, based on the market, is not only was it in a monthly buy, it's been in a weekly buy, it's been in a monthly buy signal. And look at the pullbacks. They are met with aggressive buying. You can see it as these tails reveal buy signals. It was just a matter of being at the right place at the right time, having the scan to show that. It's just a matter of the market popping. In any event, that is a kind of a little wedge formation that, who knows? I mean, it's something worth following to see if there's an accumulation of volume in the market over time. But that wedge formation is one of my favorite patterns that I like as a continuation. But one of the neat things is you can clearly see over here and if you can't, you can see the blue arrow right there. That's a PPS buy signal 3 days before the market triggers. And as you can see, the volume starts to rise. So you had an increase in volume according to the OBV indicator, and then of course that market blasted off. We got out, they were daily options. They were daily because we bought them on Thursday. They expired Friday. They were weekly options. They had 1 day to expiration for earnings. We bought the 85 because the measurement technique that we used demonstrated that this stock could get up between 88 and 90, which if you watch Starbucks, it not only has finally met that objective, it's exceeded that objective. needless to say, this type of analysis using these patterns, this momentum indicator gives you defined entry, defined stops, and combined with a couple other nuances that we like to incorporate to improve our edge in the market. It's just a matter of scanning and seeing if the criteria is met for better results and more consistent results. Now, if you're interested in learning more about this, here's how I can help you. First off, if you have an account on TradeStation, then Person's Pivots are free on the App Store. If you have Thinkorswim, both Person's Pivots as well as my PPS buy and sell indicator arrows are available for all clients on Thinkorswim. Tonight I have a very special offer. And I think, to be honest with you, this should be mandatory required study material for all traders that are interested in improving their results, interested in using my work, and going forward. So what I have is a 4.5-hour straight to the point information study course which covers these excellent points. What exactly my PPS buy and sell triggers are and how they utilize the moving averages. There are also, as I explained in this study course, how to run scans. I also talk about the exact candle patterns, both the high close and low close doji. Next, we have Person's Pivots, which help define the trend, which we didn't even get into tonight, and also how we utilize that to determine the trend direction of the market, and also as a confirming indicator in itself. Remember, there's a hidden moving average component which filters out those support resistance levels, which give buy and sell signals. We have a program for daily, weekly, monthly, quarterly, and option expiration, especially using TOS. This course talks distinctly about my favorite chart pattern and the ways to trade the wedge with my last conditional change component, which is something else that's incredibly important and just, something extremely instrumental. The last conditional change we didn't get into tonight, I'll show in just a second, but that was introduced 10 years ago as well in what I call one of the, at least the book that's going to stand the test of time, because it has so far in the most volatile market environment. The last decade has been pretty wild and crazy. As Steve Martin said, Steve Martin, wild and crazy guy, Saturday Night Live. Candlestick and trading, pivot point trading trigger. But we also get into relative strength analysis, which is spreads, breadth analysis for stock indices. And what do I mean by this last additional change? I don't want to keep you in suspense, but this trading course is 4.5 hours. And tonight you can have this study course, which is really great because it's not just $229, but it also comes with a follow-up mentoring session that we do online. This is McDonald's, by the way, all right? This is the intraday chart. And what you're looking at, if you look at this white line right there, and you look at these subsequent white lines as the trend evolves, these are what's known as the last additional change candle. What happens is when you get a buy signal, which there was generated a buy signal, if you didn't notice the high close doji on the end of day, then you would notice the high close doji pattern on an intraday basis. But if you go long, this last additional change teaches you or shows you emphatically where your stop should go beneath that white line. We teach how that white line is generated and what it means. You'll notice that we've just been able to program this on TradeStation as an indicator. You'll notice that there's a gray line. The gray line is what we call the bearish LCC. So if the market is going to give a sell signal, which is that arrow, which defines that, at least for the intraday basis, the trend is ended, okay? And once it closes, if you were trailing your stop as a day trader, you'd be stopped out right there. If you wanted to go counter trend and trade the short side, you would be selling the market and placing your stop above that gray line. This is the last additional change candle. By the way, today was kind of an interesting day trade. This whole day trading mini S&P week has been a increased in volatility, something that we predicted we don't want, and I will not put out those predictions for all the students in the room tonight. I'm not going to ever do that again because it's just for day trading. It's horrible. But anyway, looking at momentum and looking at defining the last conditional change and how it works for day traders. If the market generates a buy signal and the market starts to move up, it gives you definitive levels of where you can place your stop. And then if the market takes out that last conditional change, then you get a sell signal. You know that you can place and go short the market and place your stops above those gray levels, okay? Or scale out and take profits. But that's the last conditional change, just to let you know how relevant it is and important it is. It's been programmed as an indicator. That's how important and valuable it is. But if you're not familiar with this, it's taught in this trading course. I also have a new mechanical trading strategy system. If you know about the PPS and if you know about my last conditional change, great. You want to have an incredibly new mechanical trading system which defines what to look for, which comes up an awful lot. We have our PPS breakout system strategy, and it gives instructions for placing your entry orders, your stops, setting profit objectives, scale outs, trailing stops, plus it gives my method for options trades, selecting the right strikes and the right expiration dates. And I go through a nice, incredibly detailed outline specific to options and option trading for a directional strategy. So that combined, if you wanted to buy both packages, you can get both the bundle package, purchase both courses for $4.95. It comes complete with trading the PPS indicator, combining the person's pivots, my PPS breakout strategy, and next of all, we have a 1-hour online Q&A mentoring session with access to the recording. So you study the material, we get together, and guess what? We're going to answer questions and go over the material one-on-one. This is not a short-term program. This is approximately, I believe, a total of close to 7 hours combined of education with no nonsense, straight to the point information. Buy here, sell there, here's what you do, here's what this is, here's how this works. You can also, as a special invite, come in and join our trading for 2 weeks and see how we put this all together. What's special about that? Well, it includes our Monday planning and scanning session with my weekly observation newsletter. So that would be distinct for looking at, for example, even my weekly thoughts, which are posted on the blog, but I just wanted to share with you. It comes complete with, here's our bullish stocks for the week that we're looking at. Almost every single stock this week's for bullish setups are working. Next, we come up with, this is the trade that's giving me, just was enacted, it's giving me a little bit difficulty, but didn't have time to talk about it tonight. Biotech. Biotech, the IBB, by the way, that's the time, Bill. The IBB is enters, just to let you know, seasonally weak period of time. Another one is Sherwin-Williams. This stock is not just parabolic, but it enters a seasonally weak period in March. We're looking for resistance for triggers to sell short between 287 and 305, and it's in that zone right now. We also, for commodity traders, list all these spread trades, which have done marvelous. I mean, incredible. But anyway, we invite you. The weekly observation includes something anyone can get anywhere, the reports, but it's all nice to have it on one sheet for the week. You know what earnings are coming out, you know what economic reports are coming out, and that, for example, tomorrow, Herbalife after the bell, you got Kohl's, Sears. So you have all that information so that you have a way to plan the week. Also, we talk about, hey, here's crude oil consolidation. Here's what we need to do to break out. Gold also, by the way, we're leery of selling. We're telling people we're not getting short near $11.95. That's the monthly person's pivot support. any event. So that's all great information there, and that's what's covered in our Monday planning and scanning weekly observation. If you're interested in that information, please go over and you can click on this link, personsplanet.com, pivots. It'll give you that information right there. More importantly, for those that are interested, you go over to and you can choose the bundle package, both courses. This is the information that tells you what you get, or you can buy it separately depending on your level of interest, what you want. Either way, it's incredible information. We put out some really solid trade information backed by what I like to tell people is trade by the facts, and the facts of the tools and the techniques that we have to utilize. With that said, that concludes tonight's session. I wanted to say thank you all very much. We have a wonderful presenter and a great speaker with a lot of experience. His name's Manesh Patel, and so therefore, let's, if you're interested in further information on this presentation, just remember it was recorded, and we will have that out for you guys sometime tomorrow. So anyway, thank you all very much. Definitely I would take, like I said, this information should be mandatory reading. I don't think a lot of people have had access to this much detail before. It is something that everyone should take advantage of. With that said, I'll leave you to our next guest. Thank you all very much. Have a great evening. Thank you.
All right, thanks, John, and we will keep on moving right along, guys. Thanks, John. That was good information. We appreciate it. Everybody, I put my email out there. If anybody has questions, I'm getting quite a few chat windows I'm trying to go through here. So any questions, if I don't get to you, you can email me at johnb@personsplanet.com, and then we'll get a follow-up email out with the recording probably tomorrow sometime. It takes a little while to get the video switched out. So, Manesh, if you want to do a quick mic check, we'll have you, you can go ahead and start your desktop sharing if you want to try, and we'll see if we can get you going here.
Okay, mic check.
You sound good.
Can you hear me?
Yeah. So, so guys, Manesh Patel's going to talk about the Ichimoku cloud indicator. He's going to do a great presentation here. He's actually going to look at some of the same symbols and same charts that John looked at, and look at them from an Ichimoku perspective. So, Manesh, I'll let you, if you want to hit start desktop sharing, that should kick off your screen share. And I'll mute my mic once we can see that. Yeah, look, and Manesh, it sounds like you might. Okay. And you might want to turn your mic up a little bit. Your mic's just a little bit low.
Okay, how about now?
Yeah, that's much better. All right, so so we'll wait here for a second, and did you click the little accept button to share your screen?
Yeah. Here we go. One sec. Oh.
Okay, I'm going to mute my mic now, and if you have a problem, I'll come back on. There you go. Perfect. Thanks so much.
Okay, can you see my PowerPoint, John? Can everyone see my PowerPoint? Okay. Yeah, I'm just going to start the recording. Hello, this is Manesh Patel. I want to thank John Person and Mary, and also John Bullock for putting the webinar together. It's a great honor to actually present with John Person. I've been following them for years, ever since I started trading. It's a great person I respect a lot, and I've learned a lot in my trading career from John, especially from John's Person's pivots and so forth. What's interesting is that we spent about a weekend together in Fort Lauderdale a couple of weeks ago, and what's interesting is a lot of the trades that he's entered, we've entered them also, and I'm going to show you a glimpse of that today, and it's with two separate systems. Okay, so what I want to do is I want to give you a different perspective today on trading. So I'm going to take Ichimoku, which is a standard indicator that's available for all platforms out there, and I want to show you how you could use it as a support mechanism or a double verification for another trading system. Okay, I'm really not going to talk about buy entry strategies like breakouts, pullbacks, or anything like that, because John's already gone through a high probability breakout system with all the rules with his PPS. So what I'm going to do is I'm going to sit there and show you how you could make sure that the support and resistance that you're taking that trade with is very strong. Okay, so if you've listened to me before, this is a totally different presentation, totally different angle too. I will also talk about how John sat there and took some trades off the bottom of oil bottoming out. Also talk about McDonald's too, because those are two trades that we did take two at the same time. We didn't even talk to each other, which is ironic. So we'll definitely talk about that. Okay, so let's begin. Normal procedure, as John went through on both our disclaimer too. This is for education use only. We're not soliciting you to buy or sell any particular instrument. Do so, you're doing that at your own risk. All the information is owned by EII Capital and Persons Pivot, Persons Planet. You cannot distribute or copy any of this information without written permission from us. I'm going to use a mixture of various charting platforms from Thinkorswim, TD Ameritrade, TradeStation, KeySignal, and MetaStocks too, depending on what people want to see towards the end of this presentation. Okay. Little about my background about myself. You guys could find me on LinkedIn, on Google, so I'm not going to spend much time going through my background at all. But long story short, I didn't start off in this industry at all. I graduated in '96 with my master's in electrical engineering from Georgia Tech from Atlanta, Georgia. I went into the telecom field, but trading was my hobby. So when I went down the telecom path, I started learning all the different technical systems out there. John was one of the first people I actually started learning from too, from a technical perspective. Long story short, in 2007, I retired from the telecom industry and took up trading full-time. Got picked up by an institution, managed currencies and stocks. Eventually became a CTO for that firm that created high-frequency machines and behavioral finance machines. At the end of 2010, I pretty much just left the industry completely and decided to trade on my own. And today, I'm pretty much a self-trader. I manage my own money. I pretty much trade every instrument around the world, from U.S. stocks to U.S. futures to spot currencies, UK, Canada, stocks, India, Singapore, Malaysia, and Australia. I go pretty much where all the trends are. I believe in diversification too. Today, at the very end, I'm going to show you the scanner. It's something that we just released today, a new forecasting scanner, which is going to give you the ability to scan the entire globe and look for great opportunities out there. Okay, and you can take those same opportunities and use John's PPS indicator to sit there and place the breakout trades too. Okay? So again, you can find me on the web, so I'm not going to spend much time about that at all. One of the things I realized as an engineer when I was trading and going through my path of trying to figure out where my trading strategy was going to lead me to was determining what is trading all about. If you think about it, what's the sole purpose of an indicator? An indicator's sole purpose is to determine support resistance. And if you think about it, that's what trading is all about, is recognizing key support resistance values. And that's going to be the focus of my presentation today. How do you find these key support resistance values? How do you find these institutional support resistances? If you think about it, what do you do as a trader? Okay, one of the things as a retail trader that you do is that you sit there and you use various systems out there. Okay, if you're a Fibonacci trader, what do you think your chances are if two Fibonacci traders using the same system, the same person, are going to come up with the same support resistance? It's going to be very slim. So a lot of the systems out there, the technical systems, if you look at it, they're very subjective. Okay? So if they're subjective, how are you going to find the key support resistance values that really determine what's going on? The second major problem everyone has in determining support resistance is that you look at one time frame and you try to determine the support resistance for that one time, right? So what you'll do is you'll scroll back and you'll try to find where price gravitates around the most, and at that point you say that's the support resistance. What Why is that a problem? Well, if you think about it, if you're a day trader and you're on the day trading time frame, can everyone hear me okay? Is that better? Okay. I'm assuming so. Okay. So what I was getting at is that if you're sitting on a 10-minute chart and you look for support resistance, the support resistance you find is for the day 10-minute chart. And if you think about it, that's more of a day trading support or resistance. What if the support resistance for a higher time frame, such as a 240 minute, is different from yours? What if the daily time frame support resistance is different too? And that's a major, major problem that a lot of people have. They sit there and determine support resistances by looking at one time frame or at most two. Today, we're going to break that. We're going to look at 7 time frames or more in a matter of seconds and determine the support resistance. So what we're going to do is we want to find key support resistance values that are the same for all the day traders out there, all the swing traders, and all the long-term traders. So that if a pullback on a higher time frame, such as the daily time frame, occurs, you won't get stopped out if you're trading a 10-minute, 60-minute, or so forth. Okay? So the support resistances that we're going to find are going to be based on multiple time frame analysis. We're going to use multiple time frame analysis to determine how important your support resistances are and how strong they are. And we want to make sure that the support resistances that we use to trade with are the same support resistances that the day traders are thinking, swing traders are thinking, and also the long-term traders. Is everyone okay with that? Yep. Okay. Once you know what the key support resistance values are, you then need to know what's going to happen around there. That's where the system comes into play, your trading plan / your business plan. Okay? So we're going to look at what's going to happen around these key support resistance values. And we're going to look at them from different perspectives. Okay? So the number one goal in this workshop today is to determine what the key support resistance values are and then see what happens at these support resistances. Will it break it to start a trend, or will it bounce off there to continue to go in a counter trend mode? So these are the 2 different scenarios that we're going to look at. Okay? And so I don't want you to sit there and become one-sided, where if you see a major resistance, prices coming up to that resistance, and you think it's going to basically bounce off there. I want you to be neutral and say, this is a critical point, this is a timing element right now, where prices come up to this major support resistance, and now what I'm going to do is I'm going to wait to see exactly what it's going to do. If it breaks that resistance, I'm going to now start looking for a bullish setup. If it basically holds that resistance, I'm now going to start looking for a bearish setup. Okay? So I do not want you to get one-sided at all. I just want you to think about one scenario. It's a major support resistance, and something's going to happen at that point. Everyone good with that? Okay. So, why Ichimoku? Why are we using Ichimoku as a tool today compared to moving averages, CCI, Bollinger Band, MACDs, and so forth? If you look at Ichimoku, Ichimoku gives us huge advantages that other indicators can't give us. One of the things it does is it allows us here to work on any time frame out there. Okay, it does not discriminate on any time frames at all. So you could use Ichimoku on a tick level chart, you could use it on a 5-minute chart, 6-minute, 7-minute, 10-minute, 30-minute, 1 hour, 2 hours, 4 hours, daily, weekly, quarterly, any time frame you want. It does not discriminate as far as time frame is concerned. 2, it works on all instruments. As I mentioned before, I trade all the instruments worldwide. You could use it for Bitcoin, you could use it for any stock market out there, from futures to stock and so forth. Okay, so it does not discriminate as far as instruments are concerned. 3rd, it has psychology built into it. One of the things I learned in my trading journey is that technical analysis by itself will not give you consistent profits. Technical analysis with money management and psychology of trading, those are the 3 components that you need in order to be a successful, consistent trader. And one of the great things about Ichimoku is that it actually has a lot of psychology built into it. Okay? Next, it also has the money management component built into it. You use the indicators in the system as a trailing stop. It also helps you achieve a 3-to-1 reward risk ratio or higher with the rules based for the Ichimoku system. Next, it's a visual based system. This is one of the most attractive things for Ichimoku, is that it's visually based. In a minute, when I show you the Ichimoku system, you're going to see this nice, beautiful cloud. That gravitates a lot of people towards the Ichimoku system, and that's one of the biggest attractive things there. Okay, so we're going to show you that in just a moment. Now, this is the most important thing, advantage with Ichimoku, and this is the sole reason why we use Ichimoku today. It allows us to do multiple time frame analysis. If you think about it, if you're using moving average indicators that's based on closing price, it's hard to do multiple time frame analysis because the indicator is based on closing price. The closing price on a 10-minute is going to be different from a 120 to a 240 to a daily and so forth. So by using an indicator based on closing price, you have a hard time doing multiple time frame analysis. Ichimoku is based on the highs and lows, so it gives you the ability to sit there and do multiple time frame analysis. You're going to see that we actually do 7 time frame analysis when we look at a particular instrument. Okay. Next, it lets you identify the sentiment within 1 second. What I mean by sentiment, if you're going to be able to look at a chart and in 1 second you're going to be able to determine if it's bullish, bearish, or consolidating. Why does that matter? Well, it matters because it helps you determine what the potential reward's going to be. Okay? If the sentiment's bullish and you're trying to bet on it going bullish, then you have a potential for unlimited profits. If the sentiment's bearish and you're trying to bet on it going bullish, that means you're trading a counter trend, i.e. a pullback where the profits are going to be limited. That's where it makes a difference. Okay? But the key thing here is that within 1 second, you're going to be able to determine any instrument in any time frame, whether it's bullish, bearish, or consolidating. Okay? Next, forecasting. This is something a lot of people have forgotten about due to computers and the new age of computers that are coming online now. A lot of people wait for things to happen, a moving average to cross another one, and so forth. By waiting for things to happen, you're giving up some of the reward. By giving up some of the reward, you don't have a potential of making a 3-to-1 reward risk ratio. You can't do that anymore. You have to know exactly where your entry is going to be, put the order out there, and wait for the market to meet your conditions and enter at that point. And we're going to show you how to do that too. In fact, we just released this morning what we call a real-time forecaster in our scanner, and I'm going to show you exactly what that is a little later today. Okay? Low risk, high reward. That's part of the money management system. In order to be consistently profitable, you have to trade a system that gives you a potential of a 3-to-1 reward risk or higher. Anything less than that, you're going to basically bound to fail. It's a matter of when. Next, volatility is built into the system, so you don't need to look at that at all. Okay? We don't use any other indicators at all, believe it or not. Okay? We're sole Ichimoku traders out there. Okay? So this slide pretty much goes for the advantages of Ichimoku. You may have found that a little boring, but I wanted to make sure we highlight what the advantages are, because if you go to the web, there's a lot of people talking about Ichimoku, and there's a lot of myths out there and a lot of misconceptions and misunderstandings. So I want to make sure it's very, very clear what the advantages of Ichimoku are, because we are pretty much the leading experts on Ichimoku out there. So what I'm going to do is I'm not going to go for the Ichimoku indicator in great detail. What we can do is follow up and give you a free ebook, which gives you the formulas for the indicators and so forth. So what I'm going to do is, due to interest of time, I'm just going to give you the indicators and show you the color codes that represent those indicators. And the reason why is I want to get to looking at live charts and looking at the live scanner and start looking at live opportunities for today. Okay? So the most important Ichimoku indicator is going to be this yellow line I'm going to show you in a minute. In the Ichimoku world, it's called Senecal Span EB. But basically, the yellow line represents support resistance for 52 bars. Okay? That's the most important support resistance line you're going to see out there. I'm going to reference everything through a color code, which is going to be yellow. I'm not going to give you the Japanese name in order to sit there and confuse you at all. Okay? So the yellow line represents support resistance for 52 bars. Okay? The green line It's called the Cajun Sen in the Ichimoku world. It basically represents support resistance for 26 bars. That's the second most important Ichimoku indicator out there. Okay? The third in the Ichimoku indicator is called the Tenkan Sen. It represents red, and it's going to basically represent 9 bars of support resistance. Okay? So, the most important is going to be yellow. That represents 52 bars of support resistance. Second is going to be green. That represents 26 bars of resistance. The third is going to be red. That represents support resistance for 9 bars. Okay? Then what you're going to do is when you get these lines, you're going to see this cloud. Okay? A lot of people get confused with this cloud. Don't sit there and try to investigate it at all. If you're trying to investigate it, it's more like going back to school. I think you need to just accept the cloud and the formulas and move on and learn how to trade with the system compared to going back to university and trying to study the indicators. Because studying the indicators is not going to give you any advantage at all. Just take the lines and learn how they work with the chart and price action. Okay? But basically the cloud is made up of 2 lines. The yellow line, which we talked about up there, and also another line which is white, which roughly represents support resistance for 18 bars. Okay? For today's presentation, today's workshop, do not worry about the white line at all. I want you concentrating on the yellow line, then the green line, and the red line. Everyone okay with that? Okay? So, if you look at the Ichimoku system, this is kind of what it looks like here. I've purposely removed price to kind of just show you how the system looks. If you look at this cloud, it's made up this yellow line here. Notice how flat that yellow line is. Remember, every little dot that makes up that line represents support resistance for 52 bars. This white line we're going to ignore. This green line here is the second most important. That represents support resistance for 26 bars. And the red one here represents support resistance for 9 bars. Everyone okay with that? Now, if you don't absorb anything in this PowerPoint presentation I give today, the one thing I want you to make sure you take away from today is this yellow line. See this yellow line here? The more flat it is, the stronger support resistance it is. If you sit there and put an Ichimoku chart on there, and you go to a higher time frame, and you see this big yellow line here, and price gets there, I would look at it as a buying or selling opportunity. And if you remember what John said, towards the middle of January, he started noticing a lot of the oil stocks bottomed out. I'm going to show you exactly why we thought they bottomed out too, because on the monthly time frame, a lot of the oil stocks got to this big yellow line there and basically bounced up that yellow line. And I'm going to show you that in just a couple of minutes. Okay? So, let's get into what we're talking about is time frame matching. Okay. Now, this is the most critical thing to understand. Reason why is this is how you're going to determine if your support resistances are institutional based or not, whether they're key support resistances, and you're also going to determine what the day traders are thinking, what the swing traders are thinking, and also what the long-term traders are thinking. Okay? So, let's go quickly and talk about the steps of procedure that we're going to go through, and we'll also go through what we're trying to do here. Okay? Tom's asking a question, the 52 period seems to be lagging. That's a question for later, Tom. Don't worry about that. We could explain that in the ebook. Just accept it for now and watch what I'm about to do. Because if you could just do what I'm about to do here, which is very simple, it's kind of like going back to kindergarten and first grade where you're matching different color lines with each other. That's pretty much the procedure I'm about to take you through. Okay, it's the same thing I'm trying to teach my son too. So, very first thing you want to do is you want to find matching support resistances across time frames. I do not want you scrolling backwards at all for 2 reasons. One, from the psychology trading point of view. The more you scroll back, the more you doubt yourself. I do not want that to occur at all. 2, when you scroll back, all you're doing is you're making sure that the support resistance is strong for one time frame. I don't care about support resistance for one time frame. I care about support resistance for multiple time frames. That's what's going to tell me if it's an institutional based support resistance or not. Okay? So that's why we're going to sit there and do that. We're going to use the 3 Ichimoku lines, the yellow line, the green line, and the red line. We're going to ignore the white line. All we're going to do is use these 3 lines, and that's it. Okay? Now, here's the steps for doing time frame matching. 1, find a support resistance on a trading time frame. So go to whatever your trading time frame is, whether you're a 10-minute trader, 15-minute trader, a 30, 60, 120, 240 daily, weekly, it does not matter to me. Go to your trading time frame and find right where the current bar is, the flat green line or a flat yellow line above the current price or below the current price. Okay? Don't worry, I'm about to give you a visual aspect of this in just a moment. Okay? 2, once you find that line, draw a horizontal line in your charting package that shows you the exact price that's there. Okay? Then 3, I want you to look at the higher time frames and see if that line, that support resistance on your trading time frame, matches a Ichimoku line, a yellow line on the higher time frame. It could be yellow, green, or red. So all we're doing is matching lines, and that's it. I want you to look at the higher time frames, and then I also want you to look at the lower time frames too. So I want you to look above you, because that's what controls your reward, and then I want you to look below you, which is what controls your stop. Everyone okay with that? Okay? And then what we're going to do is we're going to summarize. So let's step you through a real live trade that we took. And here is an example here of a pound USD, which is a spot currency trade. Now, this is a 5-minute time frame. The left-hand side is always my trading time frame. The right-hand side is always my higher time frame. Everyone okay with that? And the reason why we do that is your right side of your brain is the visual side. We always want the higher time frame to be on the visual side of your brain. Okay? Now, what we're about to do, you could virtually do with any instrument out there and with other time frames too. Okay? So, remember, first thing you do is you go to your trading time frame. In this example here, it's a 5-minute time frame. And here's my current bar. I'm going to look above me and below me, and I'm going to find a flat green line or flat yellow line. The very first one I see is this flat green line. Everyone see that? Right there? Okay? So what I'm going to do is, once I see that flat green line, I'm going to draw this white line here that tells me the exact value of that green line right there. In my charting package, when I draw that, it automatically draws that white line across all my higher time frames. Okay? So now what I'm doing is I want to see on the higher time frames which one of my Ichimoku lines matches that value to a T. Okay? If you look at the 15-minute, the red line intersects that white dashed line right there, so this is a direct time frame match with a red line right there on a 15-minute. Everyone see that? Now, with Ichimoku, it actually projects into the future, and you actually have a past. Okay? Do not worry about that at all. We'll cover that in the ebook. So this right here, it's a match with a red line, which is right at the current bar. So this is what we call it a direct match, which is the strongest one that you could get. The second strongest is if this yellow line here was exactly at that white dash line here, this is what we call a future match. If this green line here was a little higher here, this would be a past match. So the strongest is the direct, which is right at the current price. The second strongest is the future, and the third is the past. Everyone okay with that? Yes? Now, if you deal with currencies, you know there's a spread. The reason there's a difference between this yellow line meeting this white line and this green one right there meeting that is the spread. So in theory, this yellow line is matching this white line here, and so is the green. The only reason why you see the little difference there is due to the spread. Everyone okay with that? Okay? So now I'm going to compare the 5-minute to my 30-minute here, which is on the right-hand side. Okay? Again, on a 5-minute, I'm comparing the green line value, and I'm going to look here, and if you look, it intersects this yellow line here, which went up, touched that white line, and then came down. So this is a future match right there to a yellow line. Okay? If I continue, I basically then compare the 5 minutes to a 60 minutes. And when I compare the 5 minutes to a 60 minute, there's no direct match here. It's very close to the green line here. But there's a direct match right here to the past. So this is a past time frame match with the green line here for the 60 minute. Okay? If you guys have any questions, please post them so I can see them and I can answer them as we move forward. Okay? The 5 minute here if you look at it, it doesn't directly match anything in the current bar, future, or the past at all with the 120 minute. But if you look closely, it's very close to that red line, and the only different reason why you have that difference is due to the spread. So we're going to say this is close enough right there to a point it matches the red line there. Everyone okay with that? Okay. Then we're going to look at the 5 minute and compare it to the daily. And if you look at it, you can't see it quite because this white dash line's on there, but it's hitting this yellow line there, which is a flat yellow line here. So it's a direct match with a basically daily yellow line right there. Okay? So now if you sum up everything here, okay, if you remember, we started off on our trading time frame. It was a 5 minute chart. There was a green line below us, which was basically acting as a support. Okay, the green line represents 26 bars of support resistance. Each bar represents 5 minutes of information. So if you take 5 minutes, multiplied times 26, that green line represents support resistance, support in this case for 130 minutes. Everyone okay with that? Yes? Okay. If you looked at it, it did a time frame match on a 10 minute to the red line. It did a time frame match on a 15 minute with the red line. It did a time frame match on a 30 minute with a green line. It did a time frame match on a 60 minute with a red line. And it also did a time frame match with a red line on a 2 hour. And then lastly, it did a time frame match with a yellow line on the daily time frame. And if you remember, the yellow line represents 52 bars, and each bar is daily, so that goes back 52 days. Everyone see that? Okay? Now, if you think about it, if you were just looking on a 5 minute time frame, you could sit there and you could scroll backwards and you'll see how important that support is. But at most you're going to see is probably maybe 500 minutes where it's going to basically go back. There's no chance you're going to see that the support, the green line on a 5 minute goes back 52 days. The only way you could see that is by doing multiple time frame analysis. And that's why this is very, very critical. Okay? George had a question. How do you do this while trading? I'll show you, George, in a minute how to do it. But basically, you just choose your trading time frame, draw a line, and then scroll up and scroll back, and that's all you do is you match it. Initially, it takes a couple of minutes, and as you do it more and more and more, you get more practice, and it becomes faster and faster to a point you can pretty much get it down to about 5 to 10 seconds by looking at 7 time frame. If you have your charts and everything set up correctly and you know exactly what you're doing. Okay? Now, yes, Tom, it sounds like a lot, but it's not, and I'm going to show you exactly why, and I'm going to do it exactly what this on McDonald's, which is the same stock that John talked about a minute ago on how they traded it going up. I'll show you the email alert that we got with McDonald's that told us there was a time frame match there, and I'll show you the entry and everything that we entered with. Okay? So now, here's the thing. We know that this support is strong, but the most critical thing I want to do is I also want to take this one step further and make sure that the support I choose is something that the day traders, the swing traders, and the long-term traders are all thinking. So what I'm going to do is I'm going to do this. I'm going to sit there and group things in 3 categories, 3 zones. Okay? The first is what I call my day trading zone. These are 1 minute charts, 2 minute charts, 5 minute charts, all the way up to about 50 minutes. The second zone is the swing trading zone. Okay? These are trades that typically last 1 day. These are trades you carry overnight that go anywhere from 1 day to 2 weeks. So these are typically going to be your 60-minute charts going all the way up to including the 240-minute. Then you got your long-term trading charts, time frames, which are basically your daily, weekly, monthly, and quarterly. Okay, so these are the 3 zones I have here. Now, what I want to do is I want to make sure there's a time frame match in each of these zones. If you look, was there a time frame match in day trading? Yes, because I colored these the same just to kind of help people out. There's a time frame match on the 10, 15, and 30. All you need is 1. We got 3, so that was a bonus. Is there a time frame match on the swing trading zone? Yes. That was basically here, 60 minute and 2 hours. Was there a time frame match on a long term? Yes, there's a daily, which is 52 bars. So the support for the swing traders, the day traders, and the swing trading was the same, so that has a high probability of holding. Everyone okay with that? Yes? So the question is, why do you try to match price lines? Well, all you're doing is you're matching support resistances, Bruce, across multiple time frames to make sure that that support, that floor is strong, or that ceiling is strong. You're trying to find the critical area where you know something's going to happen. Because you think about what trading is all about. Trading is all about finding major support resistances and trading right around there. The closer your entry is to that boundary condition, you lower the risk. The lower the risk, the higher the probability of your reward-risk ratio. Everyone okay with that? And you could use, so James, you could use this on different strategies out there. You could use this with Ichimoku strategies. You could use this with John's PPS indicator, and so forth. And that's one of the things I wanted to display for you guys. Okay? Now, the sentiment. I'm going to take 1 minute just to quickly talk about this, and then we're going to go look at some live examples here. Okay? So how do you determine the sentiment within 1 second? See this cloud here? You look at the current price, which is right here. If the current price is above the cloud here, it basically tells you the sentiment's bullish. It's as simple as that. Okay? If the current price was in the cloud, that means you're consolidating. And you're going to consolidate between the bottom of the cloud to the top of the cloud until you break out of the cloud. Everyone okay with that? Okay? If, oops, PowerPoint's not working. Okay. If the current price right here is below the cloud, this basically means it's bearish. That's how you determine the sentiment. Everyone okay with that? Now, just like everything else, this cloud is a major support resistance. You notice this price is down here, it's far away from the cloud. That means if you sit there and try to enter here in a breakout trade, you're going to be taking on a huge risk. Okay? The closer your entry is to this cloud, the lower your risk, the higher your potential reward-risk ratio is going to be. Okay? So now, let's go and take this and let's apply it to John's PPS indicator. Okay? So this is a snapshot of one of John's trades here. If you remember one of the earlier slides he showed you, and he had this highlighted because it was the ETF, this is XOP. If you look at this is his chart right here that he sent me. Okay? So if you look at this, the XOP was going down, 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 down. The circle, purple circle here, dictates basically John's PPS setup right there. Everyone okay with that? Okay? Now, if you look at it, what we're going to do is we're going to apply Ichimoku to that, and I'm going to show you how that basically there was a multiple time frame support / resistance right around there that basically told you that was going to be a great trade. Okay? Now, since this trade right here, the natural trend is a bearish movement, this is more a counter trend trade. So this is a counter trend trade where this is going to be a pullback up, and so I need to make sure I give you the rules for counter trend. Okay? For steps for execution for counter trend, basically means you're trading a pullback. Okay? Doesn't mean it's a long-term trend. You also have to recognize it's limited profits. Okay? If it's a major pullback, it's good profits, but it's still limited too. Okay? And basically you're not on the correct side of the cloud. So if you look at it from the Ichimoku perspective and you're trying to go bullish, that means price is going to be below the cloud. That basically is telling you your counter trend. Everyone okay with that? Okay. So steps of execution. You look in the higher time frame for major support resistance. So if something's going down and you're looking at it on the weekly chart, the higher time frame of the weekly is going to be the monthly. So what you need to do is you need to make sure that price comes to a major support on a higher time frame, such as a monthly time frame. Once it does, then you could go to your trading time frame and start doing time frame matching. Everyone okay with that? Okay? Now, here's the steps here for bullish pullback, which is that XOP trade right there. Okay? What you want to do is you're looking for a time frame match resistance. If you find a time frame match and it turns out to be a resistance, that means you're trying to go bullish, you have to wait for that major resistance to be broken in order to play it going up. If you find that the time frame match is a support, then it's a support mechanism for you to go up. It's a great floor. Okay, so when you do these time frame matches, sometimes they're going to be resistances, sometimes they're going to be support. So based on what you're trying to do, you may need to wait for it to break that resistance if you're trying to go bullish, or if it's a support, it's just basically a support mechanism to tell you that the floor below you is very strong and says go for it. If you're bearish pullback, basically you're doing the opposite, where you're looking for support, you're waiting for the major support to basically break, to basically trade the pullback, and so forth. Now these are a lot of words, let's get to a lot of charts, and I think that'll make it a lot easier for you guys. So, if you look at XOP, John's chart a minute ago showed you the weekly time frame. Here's the monthly time frame. If you look at it right there, this is when the trade was taken. Look at this. This basically sat there, went to this yellow line right there, which is a major support for XOP at 44.25. So this basically bounced off the month before toward the end of the year, went below it, but at the end of the day, it closed right back above it, so it held that support here. So at the end of the year, it held it, and again in January, it held it too. So this was respecting the support at 44.25. So this monthly time frame support was being held. Okay. Now, if you look at John's chart, this is a weekly chart here. Okay. If you look at the Ichimoku chart, this is what the Ichimoku chart looked like on the weekly time frame. Okay. Now, this looks like it's below the cloud, exactly what I said. This is counter trend where you're trying to play a pullback upwards to either a flat green line when it occurs or a yellow line up there. Okay? Now I'm speeding through this because we're running out of time. This is the daily time frame of the chart. If you look at the daily time frame here, this yellow line is basically the yellow line off the monthly chart. If you look here, this flat green line here and this flat red line right there, and this is my trading time frame right there, these are major support resistances. Everyone see that? So what I'm going to do is I draw lines here on the green and this red line here, and what I'm going to do is see if a time frame matches with various time frames below me. If it does, and I'm trying to go bullish, I know I got to break this level here in order to take the trade. Everyone okay with that? So if you look at the daily, that was the green line there. If you look at the 4 hour here, what it did was it time frame matched right here to this green line in the past, and it also did a time frame match here to the yellow line in the future. Everyone see that? So the daily resistance is a time frame match to the 4 hour. If you look at the 1 hour, it basically did a time frame match to this yellow part right there and this yellow part right there for this line. It also did a time frame match here to the green line here in the past. Okay, so there's time frame matching there. And if you look at a 30-minute, there's a time frame match here to this flat yellow line here and this flat yellow line there. So if you think about it, so what did I do in theory? If you summarize it, this was a time frame match with the yellow line on the 30-minute, the yellow line on the 60-minute, 4 hour yellow line, and it also matched the green line. So I covered my day trading zone, my swing trading zone, and my long-term zone. So this was a major resistance that was basically holding the XOP trade. Everyone see that? So if I'm sitting there trying to go counter trend, I needed to make sure that what happened is that price broke that resistance right there, right here, and once it broke that resistance by closing above it, I now could start looking for a setup to take this long. Everyone good with that? And if you look at it, that coincides, and if you look at that, that's a 46.82 price, and that's roughly right here, somewhere in here is when John was looking at it too, and you can see the yellow line right here is 46.77. So we have very close to the same entries there. Everyone see that? Yes? So the time frame match I have is very close to John's PPS setup right there. Isn't that interesting how two separate systems, independent from each other, are looking at to come up with the same setups? Okay, so now let's go through another one real fast. Okay, this is the second example. This is Valero. Okay, in Valero, this was not a sharp movement down at all. This is what I call a little trickle downwards here, and then finally it decides it wants to go up. Okay, and you can see John's OBD volume right there at the bottom too. Okay, if you look, sorry, This on here, this is a daily time frame on John's setup right there. Okay? So I'm going to first look at my weekly time frame. I'm going to see if it's being held by a major support. And if you look on here, there's a couple of flat yellow lines. And if you look at it, this is a major yellow line here. It held it there. And if you look at it again, it also came and held it again at the beginning of this year too. So this support was being held. And then there also is another yellow line right there, which is trying to hold now. So this is where price is at a major support on a higher time frame. So now I'm going to go to my daily time frame, and this is my daily time frame of what the Ichimoku chart looked like right around John's PPS setup right there. Okay? So I'm going to do the time frame match on the daily. So you have a yellow line, a green line, and a red line. I basically drew lines at the yellow and the red, and watch what it does. On a 4 hour here, those lines match a yellow line right there. Everyone see that? Yes? And in the future, this very closely matches that line right there. Okay? On a 1 hour here, it matches its yellow line here, and this one matches that yellow line right there. On a 30-minute here, this matched the yellow line right there on a 30-minute. So this basically did all three zones for you. And here's a summary of everything there for you. So that's basically a major resistance that had to be broken. Once that was broken, you basically then could sit there and enter the trade. Well, James, in this scenario, you don't think of it as support resistance, you draw it. If basically, since price was still below it, it was acting as resistance. Okay, if price was above it, it'll be acting as a support. This is one reason why I say, don't think of it at all what you're trying to do. What you need to do is look at it as a support resistance, see where it matches, and determine where price is at. If you're trying to go bullish and price is below that, that's a major resistance that has to be broken in order for you to take that trade. Okay? Now, let me go for some examples now. Let's go for, let's skip some of this stuff. 1 sec. Okay. So, I'm going to pull up here. Now, if you guys remember, John talked about McDonald's. So let me bring up McDonald's. Can everyone see my screen? Okay, so this is McDonald's with the Ichimoku indicator on there. This is the daily time frame. This is a thinkorswim chart. Okay, and if you look here, I have a yellow line, a blue line right here designated here. And if you look at it, there's a red line right there. Okay, and the reason why I was looking at that is that we have a scanner that's set up that can sit there and automatically find time frame matches for you. Okay, so where'd you go? And if you look here, sorry, computer is slow. Johnson, correct about OmniVision. So if you look here, this is a scanner I set up, and it sends me emails at certain times throughout the day where I'm looking for a time frame match on a 60-minute, 240, and daily. So I'm at least looking for a 3 time frame match, and then I'm going to manually look for everything else. And this is the email I got February 23rd, and here's the details here. You can see that I got it 8:02 a.m. in the morning. And if you scroll down in here, you could see that McDonald's was a candidate here, right here. This is one of the reasons why I looked at this particular chart, because this was telling me this is a multiple time frame support. So let's go to that. So if you look at it, this red line here went flat roughly around February 15th. Okay, so what I'm looking for is this red line match here. I know it's gone up because that's hindsight, but we're looking at a trade roughly around in this zone right there. Okay, so that's the daily time frame. Let me go to a 4 hour. Look on a 4 hour here. Notice there was nothing matching here at all. Price consolidated, and eventually this green line went flat right around this area here. So I really didn't look at this trade at all until this green line went flat, and this green line came up to this point right here, which was matching the daily time frame. Okay, so that was critical. This is a timing play. If this green line had not come up there, this would not be a multiple time frame match at all, and we would not be looking at this trade. Okay, you got your 4 hour here. Let's go to a 1 hour. If you look at the 1 hour here, you could see that's matching this yellow line here. Everyone see that? Right there? And then if you go down to a 30-minute, right here, you could see here, look what it's doing. It matches at the certain points right here, this red line right here and this green line here. So you could see this was a multiple time frame match. And believe it or not, it was a time frame match on a 10-minute, a 30-minute, a 60-minute, 2 hour, 4 hour, daily. Okay? So this was a great time frame match there, and that's one of the reasons why we entered that. So there's different ways you could enter that. I'm not going to be talking about Ichimoku entry strategies at all, but what you could do is you could take this multiple time frame support when that email came there, and if you're using the PPS, all you do is look for a PPS setup right when the major support occurred, and at that point you trigger and enter there. Either that, or you could enter just on these levels here when it pulls back here. So you could use this multiple time frame match with an Ichimoku strategy, or you could use it with any other strategies out there. Everyone good with that? Yes? Now, here's what we're going to do. I'm going to show you how to look for opportunities right now. So let's pull up this browser again, and we're going to go here. So this is our real-time scanner, which basically scans the globe. Okay, the very first thing I'm going to do is I'm going to reset my parameters. Okay, and I'm going to show you how to find a time frame match on 3 time frames at least for now. So I'm going to go to a 240 minute, and I'm going to turn it on. And this is a little slow because I'm Novia taking up a lot. I'm going to turn it on, and then I'm going to come down here in this little box right here and highlight the time frames I want it to match. So I'm going to choose a 240. This is brand new release today, this forecaster, which is looking for the time frame match. I'm going to click on update. Okay, then I'm going to go to the daily. I'm going to turn this on. And I'm going to come in here and I want to look for a time frame match there. So 240, daily, and weekly. Click on update there. I'm going to come to the weekly, and I'm going to do the same thing there. Now if you want to choose other time frames there too, you could do that same thing. But due to the slowness that we have on the web right now, I'm just going to choose 3. So 240, daily, and weekly. I'm going to click update, and if you scroll down, this right here are all the results. Now if you come to the general tab, we support a lot of instruments around the world. So if you just want it for like the S&P 500 or US futures or stocks, you could do that. You could even do this on sector analysis. So you could choose whatever market you want. Right now I'm just going to choose the S&P 500, and I'm going to choose that. But this is how I trade all global markets out there, and this is what I see right there. So these right here are all the opportunities that have a time frame match on the 240, daily, and weekly. Everyone see that? And you could sit there, look at any of these charts here, and all you do is look for the time frame match. Let's go to the ADS real fast. Let's quickly do this. Sorry, we're just running out of time and this is slow. Oops. So if you look at ADS here, Let's go to a 4 hour. This is the yellow line right here on the ADS. Everyone see that? The yellow line on the 4 hour matches the daily green line right there, which also matches the weekly red line right there. Everyone see that? So this is a major resistance right there. So you could basically, it's a couple of different ways you can wait. You could wait for price to come back to there if it does, and then look for a shorting opportunity. If you're bullish, you can't really take a trade until price breaks this multiple time frame resistance, and then look for a trade there. Or you could sit there and look for setups on lower time frame on breakouts and pullbacks to basically keep on going down to this multiple time frame support, which is going to be roughly right there at this green and yellow line. Everyone see that? And that's basically how we take the multiple time frame support resistances. We take that scanner, we scan for the globe, and that's basically how we find all our opportunities out there. Okay? And I'm going to quickly wrap up now because I know we're running out of time here. So this is another example I want to quickly show since this is video recorded. You guys could go back to this, but this was basically, the date's cut off here. This was January 20th with an email alert returned here, and these are all your opportunities there here. So these were all various different countries. So this is how you could trade various different countries out there. And if you can't trade those markets directly, you could trade them with ETFs. This red line here represents the major support resistance. The blue line represents when we got the email alert. And you can see in here, this is a multiple time frame resistance. As soon as it broke out, this is a 240-minute trade. This is a buying opportunity there for the Austria. This is basically a stock in the U.S. It's an ETF, which is basically U.S. travel and leisure. This right here is a Japanese stock right there. This is a Hong Kong stock, and so forth. Okay? Now, I did not go through everything in Ichimoku. I gave you a little glimpse of what the power of Ichimoku could offer by just using its indicators. We did not talk about any entry strategies at all. We did not talk about anything at all. Okay? So, we basically talked about how you use those support resistance lines to find how we use the Ichimoku support resistance lines to find the key institutional support resistances. Okay, if you want to learn more about Ichimoku, we do have a DVD/download right there, and I'm going to talk about that. It's called Everything About Ichimoku, and this basically DVD/download, it gives you everything that you need to know about Ichimoku plus more. Okay, here's the agenda from the DVD. Module 1, it covers the foundation of Ichimoku. We also talked about the secrets in the original books. A lot of people are trying to charge you for that, so we're going to actually reveal that. This is the first time I actually revealed it out there due to all the information that people have been putting out there, myths and stuff like that. So I'm actually going to go through all the myths, talk about what's true, what's not correct, and so forth. Then we're going to talk about the indicator by itself. We're going to compare the Ichimoku indicator to moving averages and why Ichimoku is superior to moving averages. Okay? Then we're going to go over the indicators in great detail from the formulas, and we're going to go through what all those indicators, the properties are, and other things that you have not talked about them. We'll go for them in detail. We'll talk about the cloud. We'll talk about the sentiment of it, the volatility that's built into the cloud, along with the twist that represents timing elements too. And then we go through time frame matching, so I'll elaborate more on what I just did today in great detail. We talk about the various different Ichimoku strategies out there. There's various Ichimoku strategies. This one, the Kumo number module 6, is pure trend trading to allow you to get into institutional runs from the very beginning. Tinkerton Cajunton is more towards a continuation type of strategy. This is a continuation strategy. This is a timing element strategy. This is a timing element strategy there too. And basically at module 12, I sum up what strategies in here work and what they don't work. I also talk about combining strategies for optimization too. So this DVD goes through everything you ever need to know about Ichimoku in one simple form, where we literally just sat down with no people on a webinar at all and just did straight recordings and stuff like that. So it's raw data in its best form, as I call it. So if that's something of interest to you, you could sit there John's going to give you a promotion in a minute. I'm going to show you. Oh, here we go. If you go to our website here, that's basically right there. The regular list price is $2.99. If you're getting it shipped, it's $3.09. So that's the DVD right there. And John will give you a promotion in just a minute with John's PPS indicator there too. Other things we offer, this is one of our hottest sellers out there. We have a 1-month mentoring. It's a weekly mentoring course where we step through, teach you both breakouts and pullback strategies with a high probability strategy. You go out, you put trades on, and we give you feedback on why you're losing, and we help you optimize everything. So this is a full-blown 1-month mentoring course there. And then we also have DVDs for if you're learning how to do Forex market. We have a Forex 101, which teaches you everything from technicals to fundamentals, everything about Forex. So if you want to learn what a pip is and how it works, we teach you that there. We also go for various technical indicators in there. And then we also go for Options 101, where we talk about what options are, how to do risk graphs, and we also talk about unusual options activity. And then we do have bundle packages too. If you're looking at the scanner, here's the information about the scanner. If you're looking for one class like stocks, it's only $59 a month. And also you could sign up for a free 30-minute session where we'll go through and show you how to use the website in order to do time frame matching or other things out there too. Okay? So John, I think I'm done from my side.
All right. Well, thank you, Manesh. That right. So thanks, Manesh. That was a great presentation. And guys, I do have one good offer. I've got a follow-up email that's going to be going out here in just a few minutes. But John Person and Manesh both, I got together with them, and we wanted to make a special offer for their introductory classes. So Manesh's everything you want to know about the Ichimoku cloud indicator, and then John Person's PPS breakout system. We put together a bundle for that. I'm going to drop the link in the chat room here. We bundled that together for $350. So probably about the best $350 you can spend. I know we've gotten a ton of great feedback from John's clients that have taken that class, and a ton of great information feedback from Manesh's clients that have taken the class. So we'll definitely get a follow-up email out to you. I did drop in the tray a little bit earlier Manesh's everything you want to know about Ichimoku Cloud special offer. So normally that video is $2.99, and we're offering it for $1.89. So anyway, I wanted to just thank Manesh. That was a great presentation, and I thought it was interesting to see how you can look at high probability breakouts of two different type of indicators. I appreciate the time that John put into this and Manesh put into this, and I'll get this email out to you, and just thanks very much, guys, and have a great night. Oh, and here, I'll put my email in one more time. I had a couple people emailing me, messaging me. If you have any questions, all right, thanks, everybody. Have a great night.